We're all swimming in information these days, aren't we? Just this constant wave hitting us. How do you actually filter through it all?
Yeah, cut through the noise and figure out what really counts.
Exactly. And that's what we try to do here on the Deep Dive.
Get straight to the core.
Today, we're going to take a really close look at corporate strategy. Specifically, how a company handles that balancing act between adapting super fast and sticking to its core principles.
And our source for this is pretty interesting. Excerpts from Markel's 2015 annual report.
Right, not just any report. This one reflects on their 30 years as a public company, right when things were really starting to speed up technologically.
So our mission today is, well, it's twofold, really. We want to unpack what was changing at Markel back then.
And just as importantly, what stayed the same? What were those constants?
Exactly. How do you blend that cutting-edge stuff with the principles that have always worked?
So get ready for a shortcut to understanding long-term strategy, a real look at financials under pressure, and maybe surprisingly, the sheer power of company culture.
You should walk away with some real aha moments. Practical stuff, too.
Definitely. So let's dive into Markel's 2015 story.
Oops.
Let's start with the obvious thing the report hits on right away.
Yeah.
The world is moving faster, business change is accelerating. How did Markel face that back in 2015?
Well, what's really key here is they didn't just react. They formally embraced this idea of continuous learning. It wasn't just a catchphrase.
More than a buzzword.
Much more. They committed to using, and I'm quoting here, new tools of technology and analytic disciplines. The goal was to sharpen up their decision-making.
Okay, sharpen decisions and the specific aims.
Pretty universal, really. Increase speed, make things easier for customers.
And lower expenses, the
right.
classic trifecta.
Right. But it was about turning data into action, not just, buying new software.
Okay, so that's the aspiration. Faster, easier, cheaper. But how did they actually make that happen on the ground? What were the practical steps?
The report gives some good examples. One was a big data warehouse project led by Brad Cascaden and Mike Cyphers.
A data warehouse. So not just storing data, but making it usable.
Exactly. It pulls data from different places, structures it, makes it accessible. This gave their underwriters, actuaries, financial folks crucial insights right when they needed them.
Empowering them with data.
And it didn't stop there. They hired Reed Colson to actually lead a new analytics department. They explicitly went after big data.
Big data, analyzing those huge, complex data sets.
Yeah, to find patterns, trends, things you wouldn't see otherwise. The aim was boosting the speed, granularity, and effectiveness of daily decision-making, right across the board.
Sounds like a major internal shift then. Not just tech, but how people work with information.
Definitely. Which leads to the next point. How did this efficiency drive affect operations and, crucially, their people?
Right, because big changes can be disruptive.
For sure. And they tackled that head on. In 2015, they did a comprehensive review and consolidation of their claims operations.
Under specific leadership.
Yes, Nick Conca, Hannah Purves, Mike Clancy, and Alex Sardinia are mentioned. But this wasn't just a one-off. It was part of a bigger, multi-year thing called the One Markel Initiative.
One Markel. That started earlier.
Yeah, back in 2009. And it continued through their big acquisition of Altera. The whole idea was to knit together all these different parts, especially from acquired companies.
Streamline things.
Exactly. Make it smoother for customers and find those cost savings by unifying functions. It's a classic integration play, really.
But integrating operations, consolidating like that, it often creates uncertainty for employees, doesn't it? How did they handle the human side of this?
That's a great question, and the report gives us a glimpse. They use a third party for anonymous employee feedback and engagement process.
Get honest opinions.
And the feedback. It showed deep loyalty. People really connected with the Markel culture, but they also clearly asked for more training, increased training opportunities.
Okay, so what was Markel's response?
They listened, they ramped up training, but with a specific focus emphasizing specific skills and techniques as opposed to credentials.
Practical skills over just degrees or certificates.
Right. It was about empowering people to adapt, to grow with the changes, and ultimately keeping good people and attracting new talent, investing in their human capital.
So lots happening internally, but you mentioned a big external move too, something that caught my eye in the summary. The acquisition of Catco.
Ah, yes, Catco, led by Tony Belil, described as an innovator in the creation of insurance-linked securities.
Insurance-linked securities. ILS. Okay, that sounds important, maybe a bit complex. Can you break down what ILS are and why Markel would buy a company like that?
Sure. Let's simplify ILS. Think about a big risk, like a hurricane hitting Florida. Traditionally, insurance companies cover losses from their own capital.
Right.
ILS basically takes that insurance risk, the potential payout for the hurricane, and turns it into a type of bond or security that investors can buy.
I mean, investors are backing the insurance risk directly.
In a way, yes. Instead of just the insurer holding the risk, capital market investors take on specific defined risks. Catco specialized in structuring and managing these deals, finding capital for very specific types of risk.
So Markel wasn't just adapting internally, they were buying new ways of doing business.
Precisely. It shows them moving beyond just traditional reinsurance, tapping into capital markets more directly, expanding their toolkit, essentially.
And what was the strategic benefit?
Well, it expanded their offerings globally, and crucially, the report notes this deal gave Catco the ability to market its products in the U.S. They'd previously focused mostly outside the U.S., so new markets, new methods.
Okay, so we've got a picture of Markel actively changing tech, analytics, operations, even acquiring new business models like ILS.
Yeah.
But you said part of the story is what doesn't change. If everything's moving so fast, what's the anchor?
The anchor, according to the report, is crystal clear. It's their culture. They see it as a profound advantage.
The Markel style.
That's the one. It's the element they point to as remaining fundamentally the same, guiding them through all this change.
I like that name, the Markel style. And the report says it was written way back, even before they went public in 1986.
That's right. And it's stressed that this isn't just some dusty plaque on the wall. It's embedded within the people of this organization.
Embedded. So what are some of those core ideas, the timeless principles?
Things like a commitment to success, hard work, a zealous pursuit of excellence, honesty, a sense of humor, and quality. That called these internally valuable attributes.
Honesty and a sense of humor, side by side. Interesting.
It speaks to the culture, doesn't it? The real insight is that this embedded culture acts like a reliable compass, especially when the external environment is so chaotic. It also fosters a strong team orientation.
Meaning people put the team first.
Yeah, being willing to put aside individual concerns in the spirit of teamwork to achieve success. That's a direct quote.
That kind of deep-rooted culture sounds like a massive asset, especially in unpredictable times. But let me play devil's advocate for a second. Can a really strong embedded culture sometimes make it harder to change, to embrace truly new ideas? Does the report hint at that tension?
That's a fair question, and the report addresses it, maybe implicitly, through that constant emphasis on continuous learning.
Ah, so the culture itself includes the need to adapt.
Exactly. The Markel style explicitly includes striving for a better way. So while the core values, honesty, teamwork, excellence, don't change, the methods they use are always under review. It's got a kind of built-in anti-stagnation mechanism.
That makes sense. Prevents the culture from becoming rigid. Okay, so culture is constant. What about their core business strategy? Has that shifted over the decades?
Remarkably, no. The report is emphatic that their fundamental strategy has been consistent for over 30 years. It's a dual approach, specialization and diversification.
Specialization and diversification. At first, listen, that sounds like they pull in opposite directions.
Yeah.
How do they manage both?
It's less contradictory, more balanced. Think of it this way. Specialization lets them build really deep expertise in certain niche markets.
Become the go-to experts.
Right. That builds trust, long-lasting relationships with customers, year after year.
Okay, that's specialization. What about diversification?
Diversification is about spreading the risk. It allows them to adapt and grow as different markets change and protects their overall financial health if one particular area hits a rough patch.
So one provides depth, the other provides breadth and resilience.
Precisely. And 2015 was apparently a perfect example of why this works. The report states they had meaningful profitability from our insurance and Markel Ventures operations, while investment returns experienced challenges. So the diversification across insurance, investments, and their ventures businesses really cushioned the blow from struggling investment markets. The model proved its worth.
That really showcases the resilience piece. It's baked into the design.
Absolutely. It's a systematic strength.
And this ties back to that continuous learning idea again, doesn't it? The report calls it no more important idea at Markel, striving for a better way since before the IPO.
It does. Technology changes the tools, sure, but the core task, getting better, remains the same. And this learning culture is deeply linked to their other constant, a long-term time horizon.
Thinking long-term, not just quarter to quarter.
Absolutely. Decisions are framed around the long-term interests of the Markel Corporation. They actively avoid short-term wins if they might cause long-term problems.
How do they ensure that happens in practice? It's easy to say long-term.
One key way is through their incentive systems. Compensation is measured over multiple years, not just a single year's results.
So you reward the long-term thinking.
Exactly. It aligns behavior with the philosophy. Good decisions that take time to pay off still get recognized. It reinforces that whole mindset.
Okay, so we've got the changing elements, tech, analytics, ILS, operations, and the constants, the Markel style, specialization, diversification, long-term view, continuous learning. Now let's hit the numbers. How did this all shake out financially in 2015? It sounds like it was a mixed environment.
It definitely was. Let's start with insurance, their biggest engine. Despite what they called intense competition, they posted record underwriting profits.
Record profits, how much?
$429.7 million. That was way up from $177.6 million the year before.
Wow. Even though competition was fierce.
Yes, and even though their gross written premiums actually dipped slightly to $4.6 billion from $4.8 billion.
So writing a bit less business, but making significantly more profit from it.
Exactly, which shows up in their underwriting ratio. They achieved their best underwriting ratio performance since 2007. It came in at 89%.
89%. Remind us what that means. Get lower is better, right?
Right. It means for every dollar of premium they earned, they only spent 89 cents on claims and expenses. That's down from 95% the previous year. A huge improvement in core profitability.
And that held true across the board.
Yes, the report proudly states every single insurance division turned an underwriting profit. It's a real testament to their unchanging discipline.
Okay, so what drove that fantastic underwriting result in a tough market?
Two main things highlighted. Their long-standing practice of disciplined underwriting. There's that consistency again, and frankly, a bit of good fortune. They had no major catastrophes hit them hard that year.
Discipline plus a bit of luck.
Pretty much. You saw it in their segments, too. U.S. insurance held premiums steady, but improved its combined ratio, that's another profit metric, significantly, from 95% down to 89%.
Hard work paying off there.
Intense effort, they called it. And Markel International also had a strong year. They successfully met the new complex Solvency II regulations in Europe.
Which was a huge undertaking for insurers.
Massive. And they also kept expanding globally, opening an office in Dubai, for example.
Okay, so insurance.
Yeah.
A stellar year thanks to discipline and lack of major disasters. Let's switch gears to investments. How did that side fare?
Investments faced a much tougher reality in 2015. The report calls it a challenging environment of low interest rates and low overall returns worldwide.
Sounds familiar. So what was the bottom line for their portfolio?
Overall, their investment portfolio produced a negative total return of negative 0.7%. Just slightly negative.
Minus 0.7%. Why negative?
Interestingly, it was mostly down to foreign currency fluctuations, specifically the strong U.S. dollar hurting the value of their overseas holdings. In local currency terms, the portfolio was actually up slightly, plus 0.5%.
Ah, the currency effect. So how were the underlying assets doing?
Equities were down 2.5%, while their fixed income holdings were up 1.6%. So a mixed bag within the portfolio itself.
So in that challenging low-return world, what was Markel's strategic response? Did they chase yield, take on more risk, or stick to the plan?
They absolutely stuck to the plan, doubled down on their principles, really. The focus was on the quality and strength of our balance sheet.
Safety first.
You could say that. They consciously built up liquidity with higher cash balances. They focused on assembling the highest credit quality fixed income portfolio possible. They even slightly reduced the proportion of equities in their overall capital mix.
Playing defense, it sounds like.
And managing risk carefully. They worked to better match the duration and currency of their bonds to their insurance liabilities. For picking stocks, they stuck to their long-held four-part process. Looking for profitable businesses, good returns on capital, low debt, great management, smart reinvestment plans, and buying them at fair prices. Nothing flashy.
And were they buying much in 2015?
They were patient. They actually sold some long-held stocks where they felt the competitive landscape had changed and reinvested that money slowly. This caution also contributed to their higher cash levels. It's a perfect example of that long-term view in action, even when headlines might scream for more aggressive moves.
Okay. Insurance strong, investments cautious. What about the third leg, Markel Ventures? They're non-insurance businesses.
Markel Ventures showed good growth. Revenues hit $1 billion, up from $838 million. And EBITDA, that's earnings before interest, taxes, depreciation, and amortization, was $91.3 million, up from $81.3 million.
So solid top line and bottom line growth there.
Yes, but the report points out something kind of ironic about how certain accounting rules affected that reported EBITDA number.
Ironic. How so? The number went up.
It did, but it could have been higher if not for two specific items pulling in opposite directions, if you like. First, they had a write-off of goodwill of nearly $15 million.
Goodwill write-off. It's usually not good news, right?
Yeah.
It relates to a past acquisition.
Exactly. It stemmed from what they candidly called a challenging acquisition, Diamond Healthcare. Writing off goodwill means recognizing the acquired asset isn't worth what they initially thought, and that reduces reported earnings.
Okay, so that pulled EBITDA down. What's the other side of the irony?
The flip side involved a successful acquisition, Cottrell. They had wonderful and better than expected results there.
Good news.
Yes, but Cottrell had an earnout provision. This means the sellers get extra money if the business hits certain targets after being bought. Because Cottrell did so well, the earnout payment increased by $31.2 million.
Which sounds like a result of success.
It is, but under accounting rules, that extra earnout payment is treated as an expense in the period it's recognized. So paradoxically, the good news from Cottrell also reduced reported EBITDA.
Wow. So a bad acquisition outcome reduced EBITDA, and a really good acquisition outcome also reduced reported EBITDA in 2015. That is ironic.
It really highlights how accounting figures sometimes don't capture the full economic picture, doesn't it? The good news, they noted, was that these specific items totaling $46 million wouldn't repeat in 2016.
Right, one-offs related to those specific deals. Did Ventures make any moves in 2015?
Yes, they acquired a majority interest in Captech, a management consulting firm. Interestingly, the report stresses this was driven by shared cultural values and a long relationship, fitting that Markel-style theme again.
What an incredible deep dive. It really paints a picture of a company, Markel, managing this tension between rapid change and solid foundations.
Yeah, embracing new tech like big data, new markets like ILS.
While holding tight to that core Markel-style culture, the specialization diversification strategy, the long-term view. It's quite a balancing act.
And the relevance for you listening is huge, I think. This isn't just a story about Markel's 2015 report. It's really a blueprint.
A blueprint for how any of us or any organization can navigate today's world.
Exactly. It shows that consistency doesn't have to mean standing still. And innovation doesn't have to mean chaos.
It's a strategic dance between the two. You don't have to choose.
Right. The real strength seems to come from blending them effectively.
So here's a final thought to leave you with. If a company's deep-rooted culture and long-term vision can help it navigate decades of market swings and tech disruption, what are the enduring principles you're holding on to in your work, in your life?
And at the same time, what new tools, what new approaches are you strategically, thoughtfully embracing to build your own lasting success? Something to think about.